If you are holding physical silver right now, there is something happening behind the scenes that almost nobody is talking about, and if you do not understand it before the next market crash, you could end up making a decision you regret for years. This is not a small detail. This is not a minor headline buried on page 10 of a financial newspaper. This is a pattern that has repeated before every major crisis in modern history, and it is quietly forming again right now. Stick with me for the next few minutes, because by the end of this video, you are going to understand exactly what smart money is doing with silver, why it matters more than almost anyone realizes, and what could happen to your savings if you get this wrong. Before we go further, if you find value in this kind of analysis, take a second to like this video and subscribe to Gold and Silver Intelligence, because we break down these patterns before they become mainstream news. Let's start with the part that catches most people off guard. Silver is not just a shiny metal that sits in a safe or a drawer. Silver is one of the most industrially demanded metals on the planet. It is used in solar panels, electronics, medical equipment, electric vehicles, and thousands of other applications that most people never think about. That means silver behaves in two completely different worlds at the same time. In one world, it acts like a safe haven, similar to gold, something people run toward when they are afraid of the financial system. In the other world, it acts like an industrial commodity, something that gets sold off hard when factories slow down and the economy weakens. This dual identity is exactly why silver becomes so unpredictable right before a crash, and exactly why so many people misunderstand what is coming. Here's where things get interesting. Historically, in the earliest stages of a financial shock, silver has often dropped in price, sometimes sharply, even while gold holds steady or rises. That single fact confuses a lot of new investors. They watch silver fall and assume the entire precious metals trade is failing. But that is only part of the story. What usually happens next is the part almost nobody prepares for. After that initial drop, when the panic spreads and central banks start reacting, liquidity gets pumped back into the system. Governments print, central banks cut rates, and suddenly the narrative flips. Silver, because of its lower price point and higher volatility compared to gold, tends to move faster and harder once that recovery phase begins. People who panicked and sold at the bottom often watch from the sidelines as the metal they gave up on stages one of its sharpest rallies. This has happened again and again throughout modern financial history, and the pattern is worth understanding closely, because right now several of the same warning signs are lining up. Let's talk about what those warning signs actually are. First, there is the widening gap between paper silver and physical silver. On paper, meaning in futures markets and financial contracts, silver trades constantly, with enormous volumes exchanging hands every single day. But when you look at the physical side, the actual metal you can hold in your hand, something strange keeps happening. Premiums on physical coins and bars have at various points spiked well above the quoted spot price. That gap tells you something the headlines don't. It tells you that real demand for tangible silver is running hotter than the paper market wants to admit. That alone would be important, but something else happened that made this even more significant. Major sovereign mints in several countries have reported stretches of record or near-record demand for silver coins and bars, even during periods when the spot price was flat or falling. Institutional reports from bullion dealers and refiners have pointed to unusually tight physical supply chains, with delivery times stretching out and certain products becoming harder to source. When paper price and physical scarcity disagree with each other for an extended period, that disagreement eventually has to resolve. And in past cycles, it has tended to resolve in favor of the physical side. Now here's the detail most people miss. Silver is not only an investment metal, it is a strategic industrial input. The push towards solar energy alone has dramatically increased industrial silver consumption over the past decade, because silver is a critical component in photovoltaic cells. Electric vehicles use more silver per unit than traditional combustion vehicles because of the increased electrical components. 5G infrastructure, advanced electronics, and medical technology all lean on silver's unique conductive properties. This means that even setting aside investment demand entirely, the world simply needs more silver every single year just to keep its industrial base running. Multiple industry analyses over recent years have pointed to structural supply deficits, meaning the amount of silver being mined and recycled has not kept pace with total demand. When you have a rising baseline of industrial need layered on top of investment demand that spikes during financial stress, you get a supply and demand equation that becomes extremely sensitive to shocks. At first glance, this seems like a slow-moving story, the kind of thing that unfolds over years, not something urgent. But it isn't that simple. Financial crashes have a habit of compressing years of pressure into weeks. When a crash hits, credit markets seize up, industrial production can slow sharply, and at the very same time, retail investors rush toward tangible assets. You get a violent tug of war between falling industrial demand and rising safe haven demand, both happening in the same metal, within the same tight physical market. That collision is exactly why silver has historically been one of the most volatile assets to hold through a crisis, and exactly why understanding the sequence of events matters so much more than simply owning the metal and hoping for the best. Let's escalate this a bit further, because the story does not stop at the level of individual investors. It extends into how governments and central banks behave. Central banks around the world have been diversifying their reserves for years, and a meaningful portion of that diversification has gone into gold. Silver does not get the same central bank purchasing attention that gold does, but it is deeply tied to the same macro forces: currency debasement concerns, distrust in long-term bond returns, and a search for assets that cannot be printed into existence. When trust in a currency or in a banking system weakens, historically both gold and silver have benefited from that shift in sentiment, even if silver's move tends to lag and then accelerate. Here's another layer that most retail investors never see. The silver market is comparatively small next to markets like currencies, bonds, or even gold. Total above-ground investable silver is a fraction of the size of the gold market. That smaller market size means it takes a relatively modest shift in demand to move the price significantly, in either direction. During calm periods, this can make silver feel sleepy and unexciting. But during a genuine liquidity event, when large pools of capital start looking for a place to go, even a small reallocation into silver from a much larger asset class can create an outsized price move. This is part of why silver has, at multiple points in history, outperformed gold percentage-wise during the recovery phase of a crisis, even though it often underperforms gold in the initial panic. Now let's zoom out and go from the individual level to the national level, then to the global level, because this is where the true size of the situation becomes clear. On an individual level, someone holding physical silver has to think about premiums, storage, timing, and liquidity. On an industry level, mining companies have to think about production costs, ore grades, and whether it is even profitable to keep extracting the metal at current prices. On a national level, countries that are major silver producers, along with countries that are major industrial consumers, are watching this balance closely because it affects manufacturing costs for critical technology sectors. And on a global level, this becomes part of a much bigger conversation about the future of the monetary system itself, a conversation involving central bank policy, currency stability, and the ongoing question of what role hard assets should play in a world with historically high government debt levels. That escalation matters because it tells you this is not a fringe topic confined to hardcore precious metals enthusiasts. It is connected to some of the largest economic forces shaping the world right now. Persistent government deficits, rising debt servicing costs, and ongoing questions about long-term currency stability all feed into the same underlying demand for assets that exist outside the traditional financial system. Silver, alongside gold, sits at the intersection of all of that, but that is only part of the story. There is another piece of this that deserves serious attention, and it involves what happens specifically in the moments right before and right after a crash, because timing behavior separates people who protect their wealth from people who accidentally damage it. In the lead up to major financial stress, markets often show subtle signs before the obvious headlines appear. Credit spreads widen, certain sectors start underperforming quietly, volatility measures begin ticking upward even while headline stock indexes still look calm on the surface. During these early warning phases, some investors who already hold physical silver make the mistake of selling into weakness because the price action feels scary and the financial media is not yet using words like crisis or crash. This is often the worst possible moment to sell because it is frequently followed by a sharp, reflexive rally once policymakers step in with stimulus, rate cuts, or emergency liquidity measures. Then, once the crash becomes obvious and headlines are dominating every channel, a different mistake tends to happen. This is when people who never owned physical silver suddenly panic and try to buy it all at once. That is exactly when physical premiums tend to spike the hardest, when mints run into supply constraints, and when buyers end up paying significantly more over spot price simply because they waited until the moment of maximum fear to act. Both mistakes, selling too early out of fear and buying too late out of panic, are driven by the same root cause: a lack of understanding of how this cycle has historically played out. This is where the situation becomes much bigger, because it is not just about price, it is about access. During periods of extreme stress, some retailers and dealers have, in past cycles, experienced actual physical shortages of certain coin and bar products, not because the metal does not exist somewhere in the world, but because the refining, minting, and distribution pipeline cannot keep pace with a sudden surge in demand. If you are trying to acquire physical silver for the first time in the middle of a crisis, you may find yourself facing weeks of delayed shipping, sold-out inventory on popular products, and premiums that have doubled or more compared to calm market conditions. This is precisely why so many experienced holders emphasize positioning ahead of time rather than reacting during the event itself. I want to pause here and ask you something, because this is the part where I want to hear from you directly. If a real crash hit within the next 12 months, do you think you would be someone who holds steady through the fear, or do you think the panic would get to you? Be honest in the comments below, because this community learns a lot from hearing how different people think through these moments. Now let's go further into the future implications, because understanding the past pattern is only useful if we can apply it forward. Several macro conditions right now echo elements of previous pre-crisis periods. Elevated government debt levels across many major economies mean that central banks have strong incentives to keep interest rates from rising too aggressively, since higher rates dramatically increase the cost of servicing that debt. That dynamic creates pressure toward looser monetary policy over time, even during periods when inflation concerns argue for tighter policy. Historically, prolonged periods of loose monetary policy combined with elevated debt levels have been supported for hard assets like gold and silver because they represent a hedge against the currency being devalued to manage that debt burden. At the same time, industrial demand for silver continues to grow structurally because of the ongoing global build-out of renewable energy infrastructure and electrification. This is not a speculative trend, it is a documented, ongoing shift in how energy and transportation systems are built. That means the baseline demand floor for silver is arguably higher now than it was in previous decades, which changes how the metal might behave compared to historical crash cycles. In prior cycles, silver was more purely a monetary and investment metal. Today, it carries a much larger industrial weight, which adds a layer of demand that does not disappear just because investors are scared. This is the bigger discovery hiding underneath everything we have talked about so far. The old playbook for how silver behaves during a crash assumed a market structure that has since shifted. Industrial demand is structurally higher. Mine supply growth has been sluggish due to years of underinvestment in new exploration and production during periods of lower prices. Physical inventories held by major exchanges have, at various points, shown notable declines, and investment demand, both from retail buyers and increasingly from certain institutional players looking for inflation and currency debasement hedges, continues to compete for the same limited above-ground supply. Put all of that together and you get a market where the classic pattern of an early crash-driven sell-off followed by a sharp recovery could potentially be more compressed, more volatile, or behave differently than it has in past decades, precisely because the underlying supply and demand skeleton of the market has changed. This is not a guarantee of what will happen, and nobody, including any analyst on any channel, can predict the exact timing or magnitude of a future crash or a future silver price move. But understanding the structural shifts underneath the surface gives you a meaningfully clearer lens than simply watching the daily price ticker and reacting emotionally. So what does this actually mean for someone holding physical silver right now, watching all of this unfold? It means the biggest risk is not necessarily the metal itself. The biggest risk is behavioral. It is selling out of fear during the first leg of a downturn before the broader liquidity response kicks in. It is trying to time a perfect entry or exit based on headlines, rather than understanding the underlying structural forces at play. It is failing to consider your own liquidity needs, meaning making sure you are not forced to sell a long-term holding at the worst possible moment, simply because you needed cash unexpectedly. And it is underestimating how quickly physical premiums and availability can shift once a crisis becomes headline news, which argues for thinking ahead rather than reacting in real time. None of this is financial advice, and everyone's personal financial situation, risk tolerance, and goals are different. So anything discussed here should be treated as an educational breakdown of historical patterns and current structural conditions, not a specific instruction to buy, sell, or hold any asset. Precious metals, like every asset class, carry risk, including price volatility and periods of significant drawdown. Anyone making decisions about their savings should consider their own circumstances carefully, and speaking with a qualified financial professional is always a reasonable step before making major moves. Let's bring this all together now, because every piece we have covered connects into one larger picture. Silver sits at a rare intersection point between industrial necessity and monetary history. It gets sold off in early panic because of its industrial ties, then often surges once liquidity floods back into the system because of its monetary ties. Physical premiums and paper prices can diverge sharply during periods of stress, revealing gaps between what the futures market says and what real-world buyers are actually experiencing. Structural forces, including renewable energy demand, years of underinvestment in mining, and persistent government debt levels, are quietly reshaping the supply and demand skeleton of this market in ways that could make the next cycle behave differently from the ones before it. The realization I want you to walk away with is this: silver is not just a hedge against inflation or a shiny alternative to cash in the bank. It is a barometer for two enormous forces colliding: the health of global industry and the trust people place in currencies and financial institutions. When you understand that dual nature, the price swings that used to seem confusing start to make a lot more sense, and the decisions around holding, buying, or selling physical silver become a lot less about guessing and a lot more about understanding the underlying mechanics. If this breakdown gave you a clearer picture of what is actually happening beneath the surface of the silver market, that is exactly the kind of analysis we focus on here at Gold and Silver Intelligence. Drop a comment below and tell me whether you think silver's industrial demand or its role as a safe haven will matter more in the next major downturn. I read through as many of these as I can, and some of the best discussion happens right there in the comment section. If you found this valuable, share it with someone who holds physical metals, or someone who has been on the fence about whether now is the right time to start paying attention. Hit like on this video if you want to see more breakdowns like this one, and subscribe so you don't miss the next analysis, because the patterns forming right now in this market are only going to become more relevant as the months go on. Thanks for watching, and I will see you in the next one.